Hey guys, welcome back to the channel. I'm Luke, an ACA qualified accountant, and in today's video we're going to discuss partnerships, and specifically I'm going to show you how to calculate a partner's capital and current account balances at the end of an accounting period. So yeah, let's get started. Okay, so in a partnership, each partner's ownership interest in the business is disclosed in the financial statements using two separate accounts. We have the capital account and we have the current account. The capital account records each partner's initial capital contribution, essentially the amount they've invested into the business. The balance on each partner's capital account typically doesn't change unless the partner injects or withdraws more capital at a later date. Whereas on the other hand, the current account is where day-to-day movement in ownership interests takes place. So the current account tracks the partner's share of profit and losses, as well as any drawings taken out of the business. If the business makes a profit, the current account balance increases, whereas if the business makes a loss or if the partner takes a drawing, the current account balance will decrease. So as a result, current account balances tend to fluctuate far more frequently than capital account balances. So to summarize this slide, the capital account shows how much money a partner has invested into a business, whereas the current account shows how much accumulated partnership profit is owed to the partner. One important point to note is that a positive current account balance is shown as a credit, reflecting the amount owed by the partnership to the partner. However, if a partner withdraws more than their balance, the account will show a debit balance, indicating they owe money back to the partnership, or they are in debt to the partnership. On the partnership's balance sheet, the capital or net assets section includes both the capital and current account balances for each partner, so it provides a complete picture of each partner's ownership interest in the business. Cool, that's enough theory. Let's look at an example which asks us to calculate the current and capital account balances for the partners in a partnership. So we have Clara, Billy and Em, they're in partnership together and share its profits in the ratio 5:3:2. We're given the following data to help calculate their year-end capital and current account balances as at the 31st of May 20x4. So we're told that at the start of the year, their capital account balances were as follows. So Clara had a £15,000 balance, Billy 7,000 and Em 10,000. These balances won't change during the year because no additional capital has been introduced or withdrawn by the partners. We're also told that the current account balances at the 1st of June were as follows. So Clara had a balance of 6,300, Billy 9,100 and Em 7,700. These are the balances that are going to change as the business made a profit of £40,000 during the year, and the partners have made drawings. They've made drawings of as follows. So Clara withdrew £2,000, Billy 5,000 and Em 12,000. So based on all of this information, we've been asked to calculate each partner's share of the profit and update their current account balances accordingly. Okay, so let's start by calculating how the £40,000 of net profit is going to be shared amongst the partner group. And we do this by applying the agreed profit sharing ratio 5:3:1. So let's start with Clara. Clara's share of the 40,000 is calculated as follows. We take the £40,000, we take her share, the 5, and we divide that by 5 plus 3 plus 2, i.e. 10, which equals £20,000. That's her share of the profit. Billy's share is equal to 40,000 times by 3 over 5 plus 3 plus 2, which equals 12,000, and M's share is equal to 40,000 times by 2, over 10 equals £8,000. So in other words, Clara is entitled to 5/10 of the profit, Billy 3/10 of the profit, and M 2/10 of the profit. The capital account balances remain unchanged during the period because no new capital was introduced. So Clara's capital account balance remains at 15,000. Billy's remains 7,000, and M's remains 10,000. Finally, let's adjust each partner's current account balance by taking into account the opening current account balance figure and adding the appropriated profit for each partner, as well as deducting their drawings, which we were provided with on the previous slide. So Clara's current account balance at the end of the period is equal to the opening balance of 6,300. We add on her share of partnership profits for the period, which is 20,000, and we deduct her drawings for the period, which were equal to 2,000. So her current account balance is equal to £24,300. Next we have Billy. He had an opening current account balance of £9,100. He accrued profit of £12,000 during the period and made drawings of £5,000. So his current account balance at the end of the period is equal to £16,100. And finally, M had an opening current account balance of £7,700. She accrued profit of £8,000 during the year and made drawings of £12,000. So her current account balance as at the end of the period is equal to £3,700. And there you have it. Each partner's current account reflects their share of the profit and the amounts they've withdrawn during the year. So that's everything I wanted to discuss in this video. That's partnership, current and capital accounts in a nutshell. If you've got any questions about the topic, please feel free to fire them off in the comments. I'm more than happy to answer them. If you like the video, please smash the like button and consider subscribing. I'm making tons of videos about the ACA qualification and the accounting fundamentals exam. So I'll see you guys in the next one.